Welcome back to the Thinking Crypto podcast, your home for cryptocurrency news and interviews. If you are new here, please hit that subscribe button as well as the thumbs up button and leave a comment below. If you're listening on a podcast platform such as Spotify, Apple, or Google, please leave a 5-star rating and review. It supports the podcast and it doesn't cost you anything. All right, my friends, it is ugly times ugly out there. I'm sure many of you by now have heard about Silicon Valley Bank. It's in the mainstream media and all the news about its collapse and the regulators taking over. So the question that comes to mind, are we about to see a 2008 financial crisis where banks are going to collapse and then the government has to bail them out? It's certainly looking like that. And I think this is just the start. And we have to see what the trickle-down effect is, what's the contagion, and how this spreads, because there's a lot of things at play here. Remember, it started with Silvergate Bank, which was one of the top banks that provided financing and banking to crypto companies. Now, they weren't inherently a crypto bank. They provided banking to other tech firms and so forth. And they chose to close their doors just this past week and liquidate their funds. And we talked about Elizabeth Warren's role in sparking part of the bank run and so forth. But they chose to shut down. But Silicon Valley Bank, they are not someone who banks, crypto specifically. They have some crypto clients like Circle, and we're going to talk about USDC and the depegging that took place. But they were providing, just according to the name, Silicon Valley, right? They were providing banking financial services to a lot of tech companies. So this is really bad, my friends. Let me give you some numbers. The biggest bank failures. First, $307 billion by Washington Mutual in 2008. Want to guess who's number two? $209 billion Silicon Valley Bank, 2023. Amazing, right? This is that big. And it comes back to that term that we heard in 2008, too big to fail. And let me give an example of the third and how much of a valuation in billions of dollars that this drops off to. So once again, 307 billion, 209 billion, which is Silicon Valley. 40 billion is the third, which is Continental Illinois Bank, 1984. Number four, $32.5 billion, First Republic Bank, 1988. And number five, $32 billion, IndyMac, 2008. So the top two are in the hundreds of millions of dollars. So this is a bad situation, and we have to watch it very closely because we could see contagion spread, and these other banks face the same problems that Silicon Valley and Silvergate were facing. So Caitlyn Long, who I've interviewed on the podcast many times, she, of course, has her startup bank, Custodia Bank, which the Federal Reserve refused to give a license to, and she's been covering this. She understands the banking world. She said, Silicon Valley Bank, what went wrong? First, management. They botched their balance sheet. Depositors had greater than 250,000, thought their deposit at a fractional reserve bank wasn't an unsecured loan to leverage borrow. It is. Fed as a regulator. That morning, the top cop said Fed supervised banks don't have bank runs. She said here, Fed FOMC created the gap risk, now kneecapping community banks, which met their bank capital requirements by buying long-term bonds. Bank risk managers didn't realize such gap risk, unhedged risk of a spike in interest rates would morph into big liquidity risk amid a bank run. So part of this bank issue we're seeing here is the Fed, of course, tightening aggressively, raising rates very fast. You remember they went from 0% interest rates and then just ramped up over the past year, right? Very aggressively. Well, that's not going to be good, right? Because you're going so aggressive. And the reason is the Fed and the US government caused this, and other central banks as well. They printed more money than they ever printed in the history of the US dollar. And all, once again, all the central banks did the same. So of course, there was going to be inflation, and then they have to fight it. And then they were so aggressive, it ends up hurting these banks and causing a lot of problems. And we saw bonds and these things collapse. So you have a trickle down effect because these banks, of course, invest some of their money in bonds and other things. So it's pretty rough right now. And a big part of the issue is just how the system is set up with fractional reserve banking. So she says here, third, the existence of fractional reserve banking means the system is inherently unstable and prone to bank runs because it's insolvent as a whole. Banks didn't raise equity capital at first sign of trouble. Bond market, who knows where true interest rates would be if not manipulated. Number 4, the DC politicians and regulators who are cheering the bank failures, the anti-tech, anti-crypto crowd, for example, Elizabeth Warren, you started all of this and you own it. The so-called free market defenders in Congress created an unstable banking system and gave us U.S. bank regulators the tools to politicize it. Number 5, so now what? She says here, loud calls for bailouts and with a puke face or puke emoji. The rest depends on whether bank runs become systemic. FDIC insurance fund isn't big enough to handle a systematic run. Absolutely right. The FDIC, they don't have the money to back up these banks, guys. Community banks need to repair their balance sheets, can happen via lower interest rates and or fresh equity capital. Number 6, on interest rates, market action Thursday/Friday means bond market already smells end of Fed QT. For those of you who don't know, QT is quantitative tightening. That means they will be rolling out quantitative easing. She says, which disproportionately sucked deposits out of community banks. Recognize, though, that the Fed pivot would keep inflation running hot. Trade-off between systematic bank run versus hot inflation. Hot potato, she said here. Number 7, on banks raising fresh capital, that's not easy for most banks to do fast because restrictive rules on who can invest in banks block huge pools of capital from investing banks. Bank mergers take about approximately 9 months, plus the same crowd in DC that started all this hates bank mergers. She says here, again, that DC crowd wanted to bring to heel the few tech and crypto-friendly banks, including Custodia Bank, which is her startup, but didn't understand how fragile the underlying system was. They've been very public about their plans to rein in fintech, including crypto. Well, they did it, and look at the mess. Absolutely. And she says here, last, if you think bank runs are happening fast, in less than 2 days for Silicon Valley Bank, just wait until the Fed's new real-time payment system comes online later this year. Runs will happen even faster. Banks need to hold a lot more cash to back deposits, but regulators aren't requiring that yet. Interesting. She said, today, here's how long it takes to withdraw your demand deposits from your bank. Hours, FedWire, 1 to 3 days, ACH, up to $10,000 instantly, physical cash. The new FedNow system will let you move money near instantly, 24/7, 365, limited initially to 100K. So I have a few thoughts here, guys. I think the Fed wants to break things. I think they know what they're doing. They know how the pipeline works. They know what's happening with these smaller regional banks. If they don't know, they don't really care about the control of the US dollar or the currency. But of course, they do care about that. And they want to make sure they have full control. And they're trying to break things, in my opinion. And the reason being is it will give them the narrative to start printing money again, to keep up the status quo, like we've been talking about on this podcast. QE was going to come back. Now, the situation and how that took place, that was to be determined. And I think we're seeing a bit of it here, right? They're going to have their narrative. And some of you may not agree with me on this, but I think they won't let a good crisis go to waste, and they're going to introduce CBDCs via these banking issues. It's the perfect setup, right? If you just think about it logically, if you want to introduce a new system, money moving on the blockchain and so forth, here's your opportunity. Banks going under, bailouts again, restarting quantitative easing despite high inflation. They need the narrative because, as Caitlyn mentioned, inflation is still an issue. So just a few facts about Silicon Valley shared by Austin Allred here on Twitter. He said, Silicon Valley Bank isn't a tech bank. It is a regional bank with normal customers all over the US and the world. Number 2, there doesn't need to be a bailout. There are acquirers and enough assets to recover funds. Equity investors in SVB will rightly get $0. 3, this doesn't just affect investors or rich people. There are hundreds of thousands of people who will be unemployed soon if nothing changes. Number 4, companies initiated transactions to send or protect money, but those transactions were blocked or delayed. ACH and wires didn't send. Number 5, even funds that were FDIC insured or in asset-backed accounts are currently unavailable. Number 6, payroll has already missed for tens of thousands because SVB has rails the payroll travels through. That money was withdrawn from businesses but never made it. So right away, crypto businesses, exchanges, and so forth who are using SVB will have issues, right? Making payroll and, business operations and so forth. So this is bad. And what we're seeing here, a report from Bloomberg today, here's the headline: U.S. discusses fund to backstop deposits in more bank fails. So they're looking to create a fund that will help the regulators to backstop more deposits at banks that run into trouble following Silicon Valley's collapse. So they're already anticipating there's a contagion effect here, right? They're looking at, we need to start a fund because other banks may fail as well. So see what's coming here, my friends? It's something just like 2008, right? And Caitlyn retweeted here some folks showing long lines at banks, some who were recently acquired by Silicon Valley Bank, like Boston Private Bank, where it's like straight up, as the person said here, shades of 1930s, where people are lining up trying to go get their money. Well, we know the banks don't have that cash, everybody's cash. It's fractional reserve, it's lent out, it's invested. So things are not looking good. And here, Caitlyn Long said, I'd forgotten that Silicon Valley bought Boston Private Bank, so its operations are in Massachusetts. She tagged Elizabeth Warren. She said, Elizabeth Warren's Senate district, her anti-tech, anti-crypto acolytes are among those who got this bank run ball rolling in DC. Happy yet? ? So this is a mess, right? And it's backfiring big time on Elizabeth Warren and these folks. Caitlyn also highlighted some articles from Reuters saying end of QT is coming. So I think, once again, the Fed has its narrative on starting QE, and I think they could introduce that new CBDC system, my friends. But nevertheless, there's going to be a lot of pain. So I don't know how this impacts many of you, whether it be crypto or just in your regular life, your job, whatever it may be. So we have to keep a close eye on this, because once again, it's not just Silicon Valley Bank. You could have a contagion spread to other banks. And right now, Eleanor Tarrant, she shared a list here of regional banks to watch. She said a list of U.S. regional banks whose shares fell more than 10% last week. There were 52 with a combined market cap as of Friday of $369 billion. They're all down, my friend. So it's ugly times ugly, like I said, guys. And here, Circle, they confirmed that they had $3.3 billion of their reserves with Silicon Valley Bank. Circle, of course, the issuer of the USDC stablecoin. Not good. Now, the good thing, they were smart enough to diversify their holdings with different banks. So it's not like the whole $40 billion of USDC is not all there with Silicon Valley Bank. But this is not good. And what we saw at Coinbase, they tweeted out just last night, we are temporarily pausing USDC to USD conversions over the weekend while banks are closed. During the periods of heightened activity, conversions rely on USD transfers from banks that clear during normal banking hours. When banks open on Monday, we plan to recommence conversions. But I think we can read between the lines here. It's not just by coincidence that they're tweeting this out when Circle just lost access to $3.3 billion of their reserves. So once again, not just crypto is impacted here, but the regular part of it, the economy and everyday life with businesses and your job and so forth. So we got to watch this, guys. It could be a rough next few weeks. Surprisingly, Bitcoin and the crypto market is not like dumping, but who knows what can happen this week. Right now, Bitcoin is over $20,500. So let's see what happens. Hopefully, this thing doesn't spread and become crazy. But man, I don't know. We are in a macro environment that's really rough right now. So the point is not to scare you, but I'm trying to help you to look at this holistically and be prepared for different scenarios, right? My hope is everything goes smoothly and this is the end of it, with Silicon Valley Bank, and okay, the Fed has its narrative. But look, we could see some other smaller banks collapse too, right? And some bank runs happening. That could be pretty bad. Now, two quick crypto items here before we wrap it up. The Pokemon company is set to enter blockchain and crypto. That's a report. Attorney John Deaton tweeted out about that. He said Pokemon cards to officially become securities per Gary Gensler. Right? Gary's trying to put everything in the securities bucket. Also, a bill was introduced in Texas to encourage and finance Bitcoin mining at abandoned oil and gas wells. So we're seeing Bitcoin mining boom in the United States. So guys, let me know what you think about this Silicon Valley issue. Once again, crypto will be affected because some of these crypto companies like Circle and so forth had their reserves. Also, some of these crypto companies need funding in their lines of credit to process payroll and all these things, right? So let's hope once again we don't have any major collapses. The other day though, one thing that worries me, guys, it's a bit funny, but it's also like, throughout history we've seen Jim Cramer tweeted out that JP Morgan is a fortress. This was when Silvergate Bank was collapsing. Let me see if we can find a tweet here for you guys. And you do the opposite of Jim Cramer. You do the inverse because he's always wrong, right? And people were like, a bit worried that this guy was saying that because, here it is. JP Morgan is a fortress. He tweeted out yesterday, actually. And actually, about a month ago, he said to buy a Silicon Valley stock when it was at $320. Oh, my God. See what I'm talking about? Jim Cramer? My God, it's insane how this inverse... if you inverse this, man, you will do well. Anyway, guys, that's the news. Let me know what you think, and I'll talk to you all later.